Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Stutland Managing Partner at Equity Armor Investments, as well as Mike Khouw, CNBC contributor and YieldMax Strategist at YieldMax ETFs. We're here to discuss the latest jobs data and the implications for the economy and future rate cuts, and how investor sentiment is impacting tech stocks. It's great to have the both of you with us, as always. August jobs report came in far below expectations, which is 22,000 jobs added. Unemployment rose to 4.3%, and June revised into negative territory. The near term, weaker jobs data will decrease the odds of a Fed rate cut, but could create shorter term volatility, as a weaker labor market is not a sign of strength. Mike, how does this align with your longer term point of view? Could it potentially be companies are trying to figure out what type of roles they should be hiring for? Don't have the answer yet.
Yeah, I mean, it's interesting when you see sort of the non-farm payrolls number today, when you see a difference of, call it, a little over 50,000 jobs. When you think about the overall scale and scope of the U.S. labor market, it doesn't seem like it's all that significant, right? Because that's less than 0.1%. But you sort of have to take it along with some of the other data that we got earlier in the week. We got ADP data. That came in a little bit light, a little over 20,000 light from the survey. And the JOLTS data also came in a little bit light. Look, I mean, the reason that gold is up, the reason that the market is up is because all three of these things put together are hints that the labor market is slowing somewhat. Now, you mentioned the 4.3% unemployment rate. That's still pretty solid. And if we take a look at wage growth, we're looking at, depending on whose measure you're looking at, somewhere between 3.7 and 4.3. We'd like to see wage growth basically at a higher level than inflation, so that it shows that real wages are gaining, which is something that they didn't do for a couple of years in a row, basically starting in 2021 or so. So I think the labor market is still okay, but this indicates that there is more room for rate cuts. We saw that. I think we lost 15 basis points in the 2-year almost immediately, and that's going to cause equities to rally. It's going to cause gold to rally. It's going to cause the dollar to weaken, and we got all of those things.
Yeah. And Brian, switching gears to this tech sector for a moment here. I mean, certainly Broadcom having its place in the sun this week for sure. Is this a broader Nasdaq story? What are the technical aspects of this rally? And how do you think investor sentiment is impacting the trading within the tech space?
Yeah, well, it's interesting when you look at the Nasdaq and it's outperforming the rest of the broader market, let's say in comparison to the S&P 500, Broadcom being one of those that's sort of railing the tech sector right now. We got news out that they will form some sort of partnership with OpenAI, and that they are going to actually devise their own proprietary AI kind of chip. Maybe that competes with NVIDIA, who knows? But certainly that partnership with OpenAI, people are very enthusiastic about what Broadcom has. And look, when you look at the weighting of Broadcom in the Nasdaq, it's, sits there in the top 10 in terms of weight. So obviously that's starting to pull the rest of the Nasdaq and the tech sector higher. The question will be does competition from Broadcom affect places like NVIDIA and other chip makers here? And does that sort of, stagnate the rest of the broad market? Now, I will say, when we get lower interest rates, back to Mike's point on the unemployment picture, and we saw, the rates sort of tick down 15 basis points off the unemployment news. Historically, we have found the Nasdaq and the tech sector to benefit from a low interest rate environment. Basically, those companies can then borrow at very cheap costs. They can either invest in infrastructure or hiring or expansion or buyouts of other companies to sort of consolidate. So that should all be bullish news. I think that's why the market sort of rallied after it took like an initial dip, but now we're actually kind of seeing a little bit of a reversal. We'll see if that hangs in there. But I think this is positive news that the AI whole play out is starting to broaden out besides just a couple names leading the entire charge.
And speaking of a breakout, let's talk about what's happening at gold, hitting another all-time high. When you take a look at the technical levels, is this sustainable, or do you think that there's more room to run here?
Yeah, I mean, look, when you look at the gold and what it's done, that rallying to all-time highs now off this jobs number. Historically, when we've seen sort of a weakening unemployment number, we've seen movement out of equities into gold or out of bonds into gold, like some form of other safety harbor, and that being gold. And look, when you look at the chart here, which I have, and you see how the consolidation that gold made. It made such a huge run in 23, 24, and then kind of just has been sitting still. We now have gotten that breakout we're probably going to sit near the target of 36.50 would sort of kind of be my target in here. So I'm not sure I'd come in here and chase it long gold. I might use some options like a call spread or something to continue to play to the upside. But, the rate cut or pending rate cuts that are coming are certainly seem to me bullish for gold.
Let's talk about the fundamentals of gold, Mike, for a moment here. Or again, or is the fundamental perspective, is there enough there to keep this moving?
Yeah, I mean, when people are wondering why is it that gold goes up when rates go down, there's a couple of reasons for that. The first is that there is a carry cost associated. In other words, if you take $1 million and you put it in the bank, you're earning interest on that at the short-term rate. If you go and buy gold, you're not earning interest. So folks who are trying to discount to a net present value, whatever an underlying asset is relative to cash, as rates go down, the value of your cash holdings goes down. So that improves, obviously, the picture for gold in that sense. As I previously mentioned, it weakens the dollar, all else equal. And when we think about gold, we think about it in dollar terms. Mm-hmm. So that's obviously going to be supportive of it as well. Lower rates promote more growth. That's the whole reason that rates get lowered in the first place, is because if within the dual mandate, the Fed believes that they need to stimulate the economy to basically get the labor market going. That's one of the reasons is that they come up with easier monetary policy. If you stimulate the economy, then of course that is also bullish for gold. So there's really three principal drivers that take place, all under the auspices of that one sort of number that you're all tracking when we look at these short-term rates.
Right, and of course geopolitical tensions and central bank buying are another reason too that we're seeing this significant move. I mean, it's not something that's recent. This is something that's, the move has been long term.
Yeah, it's interesting. If you take a look at countries like Saudi Arabia and their gold purchases and divestments over time, typically their pattern was that when oil prices were high, they would buy gold, and then as gold prices would rise, they would sell gold. And that basically has stopped. It seems like central banks are on a one-way train at this point, which is to accumulate or repatriate. And that means that you just basically have, a demand support for the metal around the world. And of course, everybody knows this. And, nobody fights the Fed. Nobody fights other central banks either. So if you're getting bearish on gold, you're fighting central banks on this one. And that's not a good place to be.
Yeah. Brian, let's switch gears a bit and talk about digital assets, particularly Bitcoin and Ethereum. I think what's interesting that's happening in the space is that performance is starting to broaden out as use cases and applications are becoming better understood, if you will. And if the fundamentals of what these digital assets are used for are starting to shine through here, how would you explain the dichotomy in performance between, let's say, an Ethereum and Bitcoin as an example?
Yeah, those two are really interesting because really those are the two leaders, right, in the cryptocurrency. You look at the charts here on Ethereum. When I take a look at that too, just like gold sort of had this consolidation, now sort of this upward trend that's like sort of continued. Now it's taken a little bit of a pause. There was a lot of excitement. If you look at Ethereum over the last month, it's up about 20%, whereas Bitcoin actually down a couple percent. So there has been this shift into Ethereum. Now ETFs, playing a little bit of a role into that. And like Mike talked about, as you sort of get this weakening of the US dollar, it goes into other places. Gold has been one of them, like we just talked about, but cryptocurrency certainly is the other place. And it seems like Ethereum being the leader right now. The reason being is you look at a lot of the stable coins using Ethereum maybe as smart contracts. They're almost acting like a stock exchange to some degree for off-market privatized sort of coins that we've been hearing on from that Robinhood might be issuing or whatnot. And so Ethereum really being the leader here, you've seen this a little bit of divergence. I would say if Ethereum pulls back, from a technical standpoint of where I'm looking, pulls back sort of like when you're looking at this 4,000 level, I would probably be a buyer there, and I think for longer term, I would want to have some allocation to this in my portfolio.
Yeah, and Mike, it goes back to what Brian was saying in terms of Ethereum and its purpose. It's more of an infrastructure play versus, a straight trading investment play such as Bitcoin.
Yeah, this is a great and important point, and it has a lot to do with the reason that Ethereum outperformed as people thought about its utility in the stablecoin space. But, you should think about these things in really two ways, really. One, of course, is that most people have thought about them as a store of wealth, and that, of course, has some validity if you're worried about currency debasement, monetary debasement around the world. But the other is that these are a platform play. And this is one of the areas where crypto, whether it's Ethereum or Bitcoin, differ pretty materially from traditional stores of value like gold, which is not a platform play. There's no unique technology to gold that you can take advantage of to affect transactions around the world simply and instantly, which cryptocurrencies do permit. So I think when you think about that, Brian's thinking on, relating them in some ways to an exchange. I think that's a good way to think about them. Think about them as a financial platform as well as potential stores of value.
Yeah, I mean, Mike, if you think about them through the lens of this is part of the evolution of the global capital markets and how they continue to get more digitized and more interconnected, really you're rebuilding its infrastructure by leveraging these types of technologies.
Yeah, I mean, this is an important thing. Whenever we think about productivity and efficiency and technological development that can improve all of those things, this is something that we should be thinking about. Now, I don't want to suggest that these things come without any associated risk. There is obviously some risk. People are somewhat concerned about the potential emergence of, basically some security issues that would be associated with quantum computing, for example, which is probably still a few years away. But, the other thing is that these currencies are also getting, nations to examine their fiscal and monetary policies more closely because it creates alternatives to that. So I'm kind of hoping for a positive feedback loop, not a negative one. And I think that the prices suggest that that is the consensus view on this.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.